It is said that trust is not a control, but it is assumption that makes every fraud possible. Let me ask you a simple question. If anybody in your organization decides to steal money from you, how long it will take before anybody notices the same? Weeks, months, 6 months, 1 year? Here is the truth. These are not detected through any controls, but these are often told by your customer, your vendor, your whistleblowers, and most commonly by the auditors. Every organization loses 5% of their revenue every year due to fraud. What I'm about to share with you is not a theoretical discussion. It's a real loss, real fraud, and the real company. And you realize that every control could have stopped this fraud, but they were existed only on the paper. There are two companies which are operating under the same industry, having a similar turnover, have the similar number of employee size, and most important thing, both has the experienced management team. Now, the one decision that each management took that ultimately defined what happened to them at the later stage. Let me introduce to company A. Company A's management believes that organization can be disrupted in two ways: externally by your market forces, the competition, or the global economic slowdowns, and internally. And internal factors are slowly, gradually become the threat to the organization, and they believe that they see that internal threats are more vulnerable because nobody sees it coming, right? So they have implemented a fraud risk management. They have identified high risk areas which are prone to fraud. They have asked uncomfortable questions to the process owners, and they have conducted a control testing, put a right control in place. They have also made a culture where everybody can report the fraud or anything. So they have ultimately implemented the whole fraud risk management in the company. Now let's talk about company B. The company's B's management believes that fraud has never happened to us. We trust our people. Our people have been in the system since long. Fraud cannot happen to our company. It can happen only to the other organization because it has never happened to us. Now the trust. This is far more common than anybody would like us to admit. This is the common human nature because we trust people with whom we have worked. We trust our processes because they did not fail or not circumvented. We trust system because nobody reported the fraud. But the trust is not a control, as I have said in the beginning. Let me tell you what happened to company B. There was a sales manager who were in the system since 10 to 12 years. So he knows everything about the company, their processes, controls, and everything. So company B were onboarding a customer. Now company B's technical team has done site visit. They have done all the technical assessment. Finance team has done the credit assessment and set a credit limit in the system. Everything was done as per the process. However, customer is also required to onboard the company B in their system. So they have also requested the trade license, your bank details, UBOs, and all the other details that are required to onboard the vendor in their system. Here is the difference. All these documents which are requested by the customer are submitted by sales manager who has been in the system since 10 to 12 years to the customers. Now what the sales manager has done, the payment term was 120 days as decided in the contract, as defined in the contract. So what he did, he has altered the bank letterhead. He has changed the account number with his friend's account number, for example, and submitted this altered bank letterhead to the customer. Now if you notice here in the UAE or in the GCC, if you see, bank does not, I would say, verify your beneficiary name and the account number, especially when you are making a large payment or you are running up like payment batches. They just transfer the amount to the account number. So there is no mechanism where bank can verify the beneficiary name which is matching with the account number. So he submitted this altered or modified bank letterhead to the customer. Customer has entered the bank account submitted by the sales manager in the system. Now company B has delivered the stock to customer. Customer has done the GR and everything was done. And by that time, sales manager has submitted his paper and has resigned from the company. Everything was done. Now few months later, company the customer has made payment to the account number which is submitted by the sales manager, assuming that this account number belongs to company B, and they have transferred the money. 1 million gone, transferred. Now this fraud was not detected by your whistleblower or not by the auditor, but the finance team who has made a call to the customer because it was showing overdue in the books of account of company B. So they have made a call, but the response that they have got is that we have already transferred this money to, for example, 1 month back, and this was transferred to this account. The financial loss was 1 million, but the cost to the business was not only 1 million, it is far beyond that, because you ultimately damage the customer relationship because customer has acted in a good faith. Then you have internal investigation costs, then legal exposures, your audit committee will raise the question, your board will raise the question. So it's not a 1 million, but the cost is far more beyond that. So here in this case, the control did not fail, but they were never existed to prevent this kind of fraud. And here is the difference. Company A has invested in the fraud risk management. They have identified all the vulnerable areas, high risk areas. They have put right set of controls. And company B believed on the trust of the employees. Company A invested thousands in order to save millions, and company B has lost millions and the additional cost. Frauds are often not done through the sophisticated technology, but these are enabled through gaps in the control, gaps in the oversight, gaps in the cultures. And these gaps can be fixed, can be mapped, and you can put a proper control in order to prevent this kind of fraud. It is said that, see, you cannot control the fraud. Only things in your control, in your hand, is a control that you can prevent the fraud to some level. This is what the video is about. I have made a presentation which will explain you about the fraud risk management framework, what is it, why the global standards are making it mandatory for the company, and how any organization, regardless of their size, can implement FRM framework in your organization. So if you are a CFO, finance director, your internal auditor, or board member, simply want to understand what is the fraud risk management framework and how it is done and implemented, this video is for you. Let's go to the presentation now. Before we get into the framework, let me tell you little about where I'm coming from. I'm a chartered accountant and a certified fraud examiner, and for the past 6 to 7 years, fraud has been full-time work for me, and not from the textbook, but from the boardrooms, from the investigation rooms, from the interviews, from the regulatory proceedings. I have conducted a close to 35 to 40 forensic engagement that are into different nature of the engagement, such as corporate investigation, the whistleblower investigation, fraud risk assessment, fraud risk management, your litigation support, etc. Apart from it, I have also worked with regulatory, I would say, investigation agencies such as Enforcement Directorate and the SFIOs in India. I have helped organization in implementing the fraud risk management framework for their processes. So yeah, let's go to the slide. So for this slide, I want to address one question that we often hear from the senior management. Is this really applicable to us? And the answer as of today is yes, for many organizations, almost for every organization. Because now what has changed in the last few years is that the fraud risk management is no longer a best practice, but it is becoming now the regulatory expectation. For example, a COSO, a global gold standard for the internal controls, explicitly requires organization to assess the fraud risk. Same as the IIS standard, which is updated in 2024, the internal audit must now evaluate whether your fraud risk management processes are adequate. So if you are operating, for example, if you are operating in the UAE, then the central bank and the SCA have made it mandatory for the board level to have oversight over the fraud risk management practices. So whether you are listed company or the financial institution or the government entity or for say large private organization, someone from be it auditor, be it the regulator, or be it the board member, is already asking whether your framework already exists. The question now is no longer whether the FRMA is required. The question is now when they will ask what should be your answer for this. So this is how your fraud risk management framework actually looks like in the practice. These are the six pillars, and each of these pillars are doing some specific job. For example, you start with the foundation, your policies and procedure. This is where you like define the rules for the organization, what is acceptable, what is not acceptable, and what happens when someone cross that lines. So this is the foundation. Then there is a fraud risk assessment. Then you assess where in your business fraud can actually happens. This is your like fraud risk assessment is not a generic exercise. It is a process level and the fraud risk scenario specific analysis. The third one is the whistleblower mechanism. What I've noticed in my experience that the most valuable intelligence rarely comes from the audit. It comes from it comes from someone inside who notices some wrong practices, and they believe that we have a like safe channel to report this fraud. Fourth one is on the fraud investigation and detection. What is your response? What will be your response when the actual fraud will happen? The fifth is the reporting to the management, the right information reaching to the right people, your audit committee or board or the regulator at the right time. And the sixth is the like continuous improvement, because the fraud evolves every time. The fraud are not unique at every time, so your framework must evolve with the fraud evolves. And the most important thing, if you combine all these six pillars, is the tone at the top. So this all six pillar can be implemented, can be documented, can be certified, but still can fail completely if your leadership does not mean it. So yeah, so let us go through each pillar one by one. The policies and procedures. So this is where every fraud framework begins, and I want to be very honest and direct about something. A policy is not a document that you create just to satisfy your auditors and the regulators. A policy is what protects you legally, operationally, or reputationally when something goes wrong in your organization. Now, at the core of this pillar, there are several policies that I have mentioned here, which are very core to this framework. Your anti-fraud policy, your code of conduct, your DOA, your whistleblower protection policy, vendor due diligence policy, your IT security policies, and these policies are like form your the policy governance framework. Each one of these policies address a specific fraud risk area, and together they leave no, if you implement everything, then you leave no gap that can be uncovered. Now let me show you how, why this is not a theory but in practice it helps your organization. For example, in one of the engagement, an employee spouse or the wife owned a vendor that has been shortlisted for a contract. Nobody raised this concern, nobody questioned the relationship. How it was caught? Just with the simple annual conflict of interest declaration, which was a part of your code of conduct process. That one policy, one form, stop a potentially corrupt contract or like our process. In another case, for example, there was one anonymous tip through a whistleblower hotline that found a ghost employee payroll scheme of 1 million, for example. The fraud has been running for months, but a whistleblower protection policies created that channel and the safety and for someone who can finally speak up when something wrong happens. And here is the legal reality that most organizations only discover after a fraud has already occurred. When an employee signs a code of conduct, that signature allows you to terminate, prosecute, and recover. Without it, your hands are tied up. I have sat in the investigation room where only reason disciplinary actions could not be taken because the organization has no signed acknowledgement on record. The fraud was proven, but the legal process was compromised because the paperwork was missing. So remember, these policies are not a paperwork, they are first line of defense and your last line of protection. The fraud risk assessment, and this is the heart, I would say, engine of the overall fraud risk management framework. Now think of this way: every organization conduct an enterprise risk assessment. But most people don't know that ERM only identifies the business related risk. However, the FRA identified the four fraud schemes. Now, these are not the same thing. ERM will tell you that, for example, your procurement process carries some operational risk. However, the FRA will tell you that your process, I would say, procurement process can be exploited specifically through the PO splitting, ghost employees, or conflict of interest between your buyer and the supplier. That specifically makes the FRA more powerful. Now, as per the ACFE, if you see, that as per their data, 86% of the fraud happens by exploiting the weak control or the absent control. Now, I'll tell you how the fraud risk assessment actually happens in the organization, how we conduct the fraud risk assessment. So, we first start with the process understanding. We go through each and every processes, for example, procurement, your sales, your trade marketing, your inventory, your warehouse, everything. That's a high level process understanding we conduct. Based on the understanding, we identify the fraud risk that is called inherent without considering your existing control into account. Then we plot all the fraud risk in our risk register. Then we develop a fraud risk scenarios. For example, there is one fraud risk, but there might be some multiple fraud risk scenarios pertaining to that fraud. Once this is done, then we conduct a workshop where we invite all the stakeholders, all the function owners into the one meeting room where we sit together. For example, during our process understanding, we might have identified 10 or 12 fraud risks for one area. We present those 12 areas to the management during the workshop meeting. Then we conduct a brainstorming with them so that we can enhance the, because they are the daily I would say enablers of these processes, so they know in and out of the processes. So what we take the input from them and we enhance. For example, during the workshop they said that okay, no, these are the three more fraud risks that you need to consider, so we will enhance our fraud risk, inherent fraud risk. For example, we identified 10 plus 3 are given by them, so it's like 13 fraud risks which we identified. Then we conduct a process walkthrough meetings with for each and every prosumer to understand what are the controls they have against this particular fraud risk. Before the control, we also do the rating of the inherent fraud risk based on the likelihood and the impact. Then we give them the score: high risk, medium risk, low risk, etc. Then we do the process walkthrough to identify the controls against those risks. We conduct a design assessment whether your control is enough to mitigate that fraud risk. Then we do the design assessment and we identify the gaps. Next part will be your control testing, where we first conduct the data analysis. Through the data analysis, we apply all our fraud hypothesis and we do the data analysis forensically. We identify the samples and we test those samples. It's not a routine normal sample testing. It's come through the data analysis. Then we do the control testing and we identify whatever the gaps in the during the design assessment as well as the control testing, and we give our recommendation for the enhancement. Once this is done, we again come to the meeting room and get their view on the observation that we identified to the design assessment as well as the control testings. And we also get their alignment on the recommendation, and we also get the timeline for the implementation so that the areas can be done. Why this is done? So we can prioritize the high risk area that can be done on a priority basis, followed by the medium and the low category, so all your fraud can be mitigated on a timely basis. So this is what we conduct. We do the assessment in this particular part, and this is not a one-time exercise. So every based on the risk capabilities of the organization, it can be again done like by 6 months or like 1 year. So this is the continuous exercise. Whatever the new fraud risk areas are identified, these are added to the fraud risk register. We also prepare a heat map to present to the management to so that they can see what are the high risk fraud areas and what we need to prioritize. So this thing we do in the fraud risk assessment exercise. How do we actually identify the fraud risk during the fraud risk assessment? This is through the concept called fraud triangle. Fraud occurs when three things align simultaneously. For example, pressure, opportunity, and the rationalization. Let me give you one real example that brings all three together. A finance manager is under a personal financial pressure. For example, he has some undisclosed liability or the debt, that is called a pressure. Second is he has a like single control owner over the vendor payments. There is no maker or checker mechanism, so that's called opportunity. And third, that he tells himself that yeah, I have given many years to the company, then company owes me. That is called rationalize. So they are rationalizing the fraud. Now, all these three factors are present at the same times. This is not a coincidence, but this is a fraud waiting to happen. And the fraud risk assessment is specifically designed to identify exactly this kind of combination before someone exploit them. Now we come to one of the most powerful and the most I would say, underutilized component of any fraud risk management framework, the whistleblower mechanism framework. Let me give you one statistic that should change how every leaders in the room thinks about the fraud detection. It was said it is said that 43 or 43% of the frauds are detected through the tips, not internal audit, not external audit, not data analysis, but through the tips. Someone inside or close to your organization knew something was wrong. The only reason it came out because there was a safe way to say it. Now, an effective whistleblower mechanism is not just a hotline number printed on the poster. It has a four component that must work together. The first one is the reporting channel, multiple channel, a 24/7 independent hotline, an anonymous web portal, a confidential email, because different people are comfortable in a different way. And if the channel does not feel safe, the report will never come to you. Second is investigation of the complaints. Every report must be assigned and investigated by the competent and independent authority with documented timelines and one critical rule: you preserve evidence before you alert the suspect. It's always the thumb rule. Third is the reporting to the committee. Material frauds goes to the audit committee immediately without any middleman. Not on the next quarter, but not on the next schedule of the meeting, but it should go immediately to them. So there should be a reporting mechanism that each material fraud should go to audit committee directly. And fourth is the training and awareness. I have classic example. We were doing audit of one of the company where they were very confident in saying that, oh, we don't have any fraud here, we have received a zero complaint during last 1 year. We said okay. Then we have conducted interviews with some of the employees. Their employees were never aware about this whistleblower mechanism. They don't know how to report any fraud or the suspicious. So they have made all the whistleblower hotline, they have made policy, they have made the SOPs, guidelines, everything. But the important thing is, if you do not tell the same to your employees, then there is no use of having such a like mechanism. Because a whistleblower mechanism where which nobody knows it, it's not a mechanism. People need to know it exists, they need to trust it, and they need to be believe, genuinely believe, and that speaking up will not cause the job. That's called whistleblower protection. Here the uncomfortable truth is, the organization that do not have this in place, the fraud usually already happening, someone already knows it, they are waiting for the reason to speak. Give them that reason, give them the channel, and you will surprise that what outcomes you will receive. And that's as I mentioned, that 43% of the frauds are discovered through the tips. So this is very important tool to identify and prevent the fraud. The next pillar is fraud detection, mitigation, and investigation. This is basically your response to when the actual fraud has happened to your organization. So the frauds are detected through, as mentioned in the previous slides, data analysis, your continuous monitoring through the whistleblower mechanisms, your surprise audit or auditor flag something. So these are the sources of your like the detection. Normally, whenever any fraud happens, they are the management or the regulator are expect the investigator to answer these questions: how the fraud has happened, when the fraud was happened, who all are involved, what was the amount involved, then what are the measures we can implement in order to prevent such kind of fraud. So this question they are looking for, and to answer this question, we have some set of the investigation methodology. So if you see in the slide, we have the investigation life cycle. First, you receive the report. Then you first of all do some basic checks or do the credibility assessment on the complaint that you received. Then first thing, as I mentioned in the previous slide, that you need to preserve the evidence first of all, because these are the core of your investigation. Then you do the analysis, you conduct the interviews with the suspects, uh, you make them to confess the frauds, then you do the reports and finding, and the next part will be what actions you are taking. Are you going to file a complaints against that particular person, or you are just sitting on a table and resolve that particular thing? So this is how the fraud detection happens, and this has to be defined in your policy, that who is going to investigate your fraud. It is whether it has to be done internally, or you need to appoint the outside uh, uh, consultant to investigate the fraud, because this require almost a good kind of expertise here to investigate the fraud. Otherwise, you will not be able to prove the question or the expectation that the management and the audit committee will have. So in this slide, and this is the last slide of the presentation, and I want to give you a practical, I would say practical case study on how a company who has conducted ERM, and then the team has conducted FRA on the same processes and the same controls. A manufacturing company conduct ERM exercise on the procurement function, and the FRM team then perform a fraud specific or fraud scenario specific assessment on the same processes. So if you see that for the vendor onboarding, the ERM team has identified there is some due diligence gap or the procurement delays as a risk in the ERM. However, in the FRA, which is fraud specific findings, they have identified the risk of shell companies linked to employees. There are risk of sanction or PAP entities being onboarded, or there are risk of fictitious vendor registration in the company. For the payment approval process, if you see the risk such as payment errors or the liquidity risk, but if you see the FRA risk, FRA specific risk, there are risk of invoice splitting below the approval threshold, or the duplicate payment going to the same vendor, or the ghost vendor payments. For the contract award, if you see, there are risks such as procurement delay or the price risk is not mentioned in the contract. For the FR, if you see bid rigging with the preferred suppliers, or there is undisclosed conflict of interest or the kickback arrangement with the suppliers. Then for the contract variation, there is scope creep or the performance risk identified in the business risk as a part of ERM. And for the FRA, you can see inflated variation order or the collusion with the process owner to inflate or submit the fictitious milestone claims. The supplier performance is the risk is focused on the quality or the supplier dependency, but when it comes to the FRA, it's more dependent on the or on the substandard delivery or related parties and all these things. So this is the like difference between the FRA and the ERM that we are talking.